Jackie, David.
I'm still reading it.
Okay.
I think it's C.
C. You also said C. David, are you here?
Yes, sir, I'm here.
I need your participation, buddy. Nicola.
For me, C.
Okay. David, you done?
I'm still thinking. I'm not quite sure though.
We are following IFE, International Future Effect. What it says, higher the interest, which means higher the inflation. And higher the inflation means lower your currency or weaken your currency or depreciation in the currency.
Of
Right?
course, it means weaken, yeah.
Okay, well done, guys. Awesome. How about this? If nominal British interest rate are 3% and nominal US interest rate are 6%, then the British pound is expected to end by about, according to IFE.
Isn't it B? B?
Is it B?
B?
You said B. Why B?
Yeah.
The difference is?
Because we divide.
Right, exactly. Because of this division, 1 plus 6% divided by 1 plus 3%. The answer would be 2.9.
Yeah.
It would be depreciate or appreciate?
Appreciate.
Appreciate, of course.
Right? Because we are talking about British pound, not the US dollar. If it's US dollar, then it would be depreciating. Okay? Well done, guys. Amazing. Now, everyone, take out your page and try to solve this question. Write it down, your name, your student ID. This is a class participation and this has marks. So I'm going to give you 5 minutes to do this. And I'm also going to read this question for those who want to, watch this video later. Assume that the US 1-year interest rate is 5% and the 1-year interest rate on euros is 8%. You have 100,000 to invest and you believe that the international Fisher effect holds. The euro spot exchange rate is 1.40. What will be the yield on your investment if you invest in euros? Okay, guys, you have 5 minutes. I'm just going to pause the video here and we are going to resume after 5 minutes. Okay, so I received your pictures in the group and all of you did a really great job and all of you are on the same track. So according to the theory, if IFE holds, then US investor is ended up earning 5%. But if these options are not given, then how you can find out? So here we go. You have $100,000 and you invested in euro, and the spot rate is 1.40. So you invested into Europe. For Europe, you need euros. So first convert your $100,000 into euros. 1.4. Answer is 71428.5 euros, right? Now you have this much euros and you want to invest in your European countries and earn 8%. So after 1 year, how much you will receive? 71428.5, 1 plus 0.08. What is the answer here? Is 77143. I just round off. It's 2.8, so I just put 3. Right? Now if you want to find out your return, and you are in US, so you need to return in dollars. So you need to convert this into dollars. The question is which rate? We are not given the rate at that time. This is a spot rate, and here we use the spot rate at that time. And the question says IFE holds. It means the foreign exchange rate will depreciate or appreciate. So this is the formula. Home is 5%, foreign is 8% minus 1. So that will be the depreciation or appreciation. So how much is that? Let me just find out here. It is 1.05 divided by 1.08 minus 1. It is 2.78% negative. So the spot rate is 1.40, 1 minus 0.0278. So the exchange rate gonna be 1.36, right? So you convert those euros. Let me just change here. So you convert those euros at the rate of 1.36 dollars. So multiply by 77143. It is 10, right? To be precise, it's exact. So your initial investment was 100,000. Your new return that you converted it 105,000. Sorry. So answer is exactly 5%. Right? So if I just press the answer here, answer is 5. Understand the calculations, or do I have to do it again? If somebody not understand that, then I'm ready to do it again. Leo, Jackie, Nicola, Carolina, Alima, David, Laura, Ploy, Michael.
No, the calculations are simple.
Right?
I understood, sir.
Okay. Okay, then let's move forward. So here we go. Answer is B. Okay. And now let's talk about the international arbitrage. So international arbitrage, it is defined as capitalizing on a discrepancy in quoted prices by making a riskless profit. Arbitrage mean risk less profit, which means with no additional risk, you are having some kind of profit. And it is very lucrative. So the financial analyst, those who work in this finance industry, especially in treasuries, bank treasuries, especially in Forex department, or those who are working as a traders, the currency traders, they are always in search of these arbitrage, which is riskless profit. It means you don't have to take the risk, zero risk, and you're finding out the profit. So these opportunities, they open up for a very small period of time, maybe for like 1 hour, 2 hour, or 1 day or 2 days. And then when everybody, start exploring these kind of activities, these kind of opportunities, so the market started to realign or coming back to its equilibrium position. Right? So if there is discrepancy, risk-less profit, everybody will jump into that one until the interest rates and the exchange rate, they are aligned, right? So that there is no riskless profit there. So there are 3 kinds of arbitrages: locational arbitrage, triangular arbitrage, and covered interest arbitrage. So the third part we already did in our last lecture, in which we talk about that, the capitalizing on the discrepancy of the interest rates of different countries, 2 different countries, while covering your position through forward contract, right? So let's talk about the locational arbitrage. So pay close attention to the name, location. So it is defined as the process of buying a currency at a location where it is priced cheap and immediately selling it to another location where it is priced high. The conventional formula of profit is, which is all time true, buy low, sell high. So you buy from that location, which is you found it cheap, you sell where it is priced high. So do I need to remind you something that we already talked about, bid and ask? What is bid? Sorry guys. Anybody's ask? Please guys, I need your participation. What is bid?
Buying price.
Buying price. And what is ask?
Selling price.
Sell.
Sorry. Now, if you want to sell, for example, if you have $10,000, you will sell at which rate?